Hey everyone, I have 5 dividend stocks that I want to share with you in the video today. All 5 of these dividend stocks are trading at value prices, and it just so happens that 2 of them are trading at deep value prices. Now, 4 of these dividend stocks happen to be in the healthcare space. One of them happens to be a sin stock. Get ready, everyone, for a really exciting dividend investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So I want to start with stock number 1. Check it out on the screen right now. This is Viatris. For those that don't know, Viatris is a spin-off from Pfizer, and it spun out of Pfizer, their Upjohn unit, and then that combined via a reverse Morris trust with an existing publicly traded company called Mylan. This is a company that makes generic pharmaceuticals and also biosimilars. Now, what's so exciting about Viatris is the stock chart, as you'll see in a minute, is trending down. No one likes it. It's a much hated spin-off, but that being said, the company is thriving and they just had blowout earnings. And so in terms of the third quarter, they really had wonderful results. They were coming in at total revenues of $4.54 billion. They had U.S. GAAP net earnings of $312 million. And the U.S. GAAP net cash provided by operating activities was $1.09 billion. Now, what's so exciting out of these numbers, though, is the free cash flow. Free cash flow is the cash flow that's left over after paying capital expenditures. And so it's a good proxy of the real cash that's being generated from this business, and it was $965 million, and that was just in the third quarter of 2021. Now, what's so exciting is they raised their guidance, and so they're raising the guidance on revenue, they're raising guidance on adjusted EBITDA, they're raising guidance on free cash flow, and they're now expecting free cash flow range of $2.4 billion to $2.6 billion, which is up from 2.2 to 2.4. Now, they're paying a dividend, and I love that, 11 cents per quarter. I expect that will increase over time after they have paid down some of the debt that this company was left over with after the spinoff, and they paid down $1.9 billion of debt in the first 3 quarters of 2021. This is one of the favorite types of companies that I like investing in because the stock is trending down. People hate this company. They don't know about it. They don't understand it. And yeah, it's not the most exciting business to be in. They are making generics and biosimilars. And so upside revenue growth over the long term, it's never going to rival something like a Johnson & Johnson, for example. But that being said, they have a viable business model. And I think more and more consumers around the world are being health conscious, and so when there is an opportunity to go after a generic prescription, that could save consumers a lot of money. I would also say this is the at-scale company doing generics and biosimilars, and so I feel because of their scale, they have economies of scale here and efficiencies in this marketplace. And so a lot of people don't like it, but I've been buying up this stock for some time now. Basically, I owned it from the old days because of Pfizer. I received my shares as a spinoff, but then I've been adding to it ever since. And so check it out in front of you right now. I have a few statistics I want to share on Viatris, and you can see it's trading at $15.54. You can see the stock chart is red. I showed a 1 year here because I'm just trying to show what's really happened over the course of this company after being spun off from Pfizer. Now, the PE on a forward basis is a 4. And so that is really amazing in my humble opinion. And I'm going to get, though, into a price divided by forward free cash flow in a minute. Maybe that's a better proxy. Perhaps the PE ratio is overstating the value here, and so I do want to look at it on a price divided by forward free cash flow in a minute. But let's first look at the dividend. So the dividend quarterly is 11 cents. This is something really exciting, and it's a 2.83% starting yield, but the payout ratio is only 12%. So where is the starting yield? It's not huge. I would say it's good in this interest rate environment, but it could go up quite a bit over time with a payout ratio of only 12%. Now, a market cap is $17.59 billion, and I just took their 2021 free cash flow estimate, the midpoint of $2.5 billion that I just shared on the prior screenshot, and their price divided by forward free cash flow is a 7. And so maybe that's more of a good way of looking at it. Maybe that's a better proxy evaluation, even better than PE perhaps. It gives a true sense of how this thing is trading, and I would call that a deep discount bargain. And so for me, I am compelled here to add more shares of Viatris. There are so many stocks that I want to buy at any given moment, and so it's difficult to focus on one or the other. I'm actually going to get into some information about this in a minute, but I'm trying really to focus on core stocks just to keep myself focused. I would say Viatris, for me, it's not a core stock, but it is so cheap. It is such a discount for a pretty good company, quite frankly, that I am compelled to buy more shares. And so that's the first stock today. Now, I want to go from Viatris, which is a healthcare company, into the next stock, which is another healthcare company. So check it out on the screen right now. I want to talk about Johnson & Johnson. And so Johnson & Johnson, there has been a lot of news coming out. And so this is a news-oriented video today. I'm sharing value stocks, value dividend stocks, but ones that are also trending in the news. And so with J&J, on November 9th, which was yesterday, there was some news that came out that basically said the Oklahoma Supreme Court overturned the $465 million judgment against J&J, basically on the topic of the opioid pandemic. Now, this is, I would say, favorable for the company. Now, I am just reporting the news here. I want to be very clear here. I am not trying to make a political statement. I'm not trying to be insensitive. My heart goes out to anyone who has faced adversity due to the opioid epidemic. My heart goes out to anyone that has faced any kind of issues out there. And so I'm not trying to say what happened in Oklahoma is right or wrong, but I'm trying to share the news with the community about what is happening in the headlines. And when this came through on the headlines, in terms of just pricing, taking the emotion out of it, taking the political views, this and that out of it, and just trying to price an equity stock and try to price it based on the data that's available in the marketplace, I would generally say that this type of news would be favorable, pointing towards a higher stock price or a more valuable company, because a major lawsuit against the company was overturned. Now, that was yesterday. Now, today, something else came out which was not so favorable. So check it out on the screen right now. What came out today actually was in relation to another lawsuit, and this is in relation to the baby powder. And so basically, they were, if you don't know the history of the baby powder topic, basically what happened is J&J took their baby powder, they spun it out into a different line of business, and they basically bankrupted that company. And so they were in bankruptcy court in North Carolina, and basically what happened is that bankruptcy court said, hey, we're going to put a hold on this for 60 days, and we're going to be directing this over to a federal court in New Jersey. And New Jersey, they're saying, is a natural fit because that's where J&J is based. That is their home state. Now, what J&J was coming back and saying is basically North Carolina, they believe that that is a better fit for the type of bankruptcy that they are going through here with this line of business, with this talc powder, baby powder business. And so this, based on my interpretation, is it delays any kind of legal proceedings, and perhaps that could be favorable in pricing the stock. But I would say in general, based on what's coming out of the company, moving over to New Jersey for this particular case is not a good thing. And so you're seeing a trend emerge here that Johnson & Johnson is a company that has a lot of legal issues and legal cases, as I think investors would generally expect, being in the industry they're in and being at the scale that they're at. I'm not trying to discount or be insensitive to folks out there who are watching the video today who have faced issues because of opioids or the baby powder. My heart goes out to anyone facing any kind of medical issues. My general philosophy, though, on such topics is I will allow the courts to rule and look at the data and make the best decisions that they can. And so far the court regarding the opioid case in Oklahoma, it was a favorable ruling, but the court action in North Carolina was not so favorable. That being said, I want to keep going and share some numbers. So check it out in front of you right now. And so what I want to show is Johnson & Johnson is trading at $164.27. Based on the forward EPS estimates, their PE is in the 16 range this year, 15 next year. I would call this a solid value for such a world-class company. This is a diversified company across pharmaceuticals, medical devices, and consumer health-related products. Their dividend is only 2.58%, but that being said, they grow it on average per year by 5.79%. This is a core dividend growth stock. Payout ratio is low enough at 43%. It will allow for some growth in the future, and that market cap is huge. It's over $400 billion. I'm actually now buying Johnson & Johnson on a weekly basis. I'm buying it very regularly. And those of you, by the way, in my Patreon already know that because I share all of my stock trades now exclusively on Patreon. And so if you haven't checked out my Patreon yet, go ahead and check out the pinned comment below. I have two tiers, and at the backyard tier, to pay respect to my old videos that I used to do in the backyard, I'm sharing all of my stock trades, and I have 50 videos at that tier as well. 50 bonus videos you unlock immediately. And in the corner tier, to pay respect to when I used to do the videos in the corner, I not only have all the 50 bonus videos in my stock trades, but I have some crypto related content as well, and all of the new videos that are coming forth. And so check it out. It's really awesome over there on Patreon. But anyway, I have been buying Johnson & Johnson stock now every week for a while now, and I'm going to continue doing so because my charter moving forward for 2022 is a focus on core stocks, and that's why even though Viatris is a deep discount value now, I'm not going to be buying as much Viatris because I need to focus on the stocks like Johnson & Johnson. That's really my focus moving into 2022. Because 2021 was such a year of distraction. I got into a lot of new positions. I got into some growth-oriented positions. I even bought a few stocks that don't pay a dividend. In fact, on Patreon, I just shared in one of my recent trades and videos a ETF that I bought that doesn't even pay a dividend. And so anyway, moving back to 2022, it's kind of back to the basics, back to the core. Anyway, a few more things. As you can see on the screen in front of you right now, the long-term stock chart for J&J is up and to the right, although it is down a little bit in recent months. And I started buying this thing in 2011 at $58.31. And so it's up quite a bit since then, but it's okay to average up in great companies. I would say it's still a value despite the share price increase. And I would say that they do have lawsuit risk here. Hey, we will see what the courts decide. I trust in the court system to look at all the data, and we'll see what happens over time. But I would say that's probably the reason that this particular stock is trading at such low PEs, is that litigation risk. And it's something that Johnson & Johnson is constantly dealing with. All right, I have another stock. Believe it or not, this one is in the pharma healthcare space as well. Let's talk about Pfizer because there's some really interesting news from Pfizer. As you can see in front of you right now, I want to start with the news because there's so much news with all of the stocks today. And so as it pertains to Pfizer, they just released their Q3 earnings, and as expected, they were extraordinary. They're really extraordinary. And so the revenues were basically up 130% year over year. Now, that is with the vaccine, and they're basically calling that now Comirnaty. And revenues grew 7% year over year if you exclude the vaccine from the results. So the third quarter reported diluted EPS 142, adjusted $1.34. Now, what's interesting is they are increasing their guidance, just like Viatris. And so it's the parent company and the spinoff are both doing well. And so they're increasing their revenues, they're increasing their adjusted diluted EPS, and they're just anticipating great performance ahead. Now, they do show, here's what's so interesting. If you look at the guidance without Comirnaty, basically the range is 260 to 265 on adjusted diluted EPS. But with the vaccine, the range is 413 to 418. So it just goes to show how important the vaccine is to their bottom line. And so it's just fascinating to see how over the course of the last few years, this company brought this solution to market, and it is really seeing just tremendous financial benefit from it. Now, to that point, I want to put it into perspective a little bit more. As you can see on the screen in front of you right now, this is another tidbit from their third quarter report. And basically what you see is some information on their revenues. And you can see that just in terms of revenues in the third quarter alone, you have $14.5 billion on vaccines. That's out of a total revenues of $24 billion. You just start seeing the sheer magnitude of what is happening here with this vaccine. It is unparalleled. It is just an unfathomable amount of money that is coming into Pfizer right now because of what's happening and the solution that they've been able to bring forth. And so with that, I want to share some numbers in front of you because like Johnson & Johnson, this one is trading at a value. It's not a deep value, deep discount like Viatris, but I would call it a solid value. And so as you can see in front of you right now, I have some numbers and it's trading at $49, and that's after it has surged in price. I want to warn the community that on Yahoo Finance, they have some really wacky earnings per share estimates, which are like $36 a share this year, $35 next year. But when I actually pull their estimates from the Q3 report, I'm just assuming that 2021, 2022 are going to be similar because I think the vaccine sales will taper off over the next few years. I think that once people have it, sure, there may be some boosters, but I don't know how much more growth is ahead. And so anyway, based on the numbers provided by the company, instead of the Yahoo Finance numbers, I get a forward PE in that 11.78 range, which I would call for this company, for what they're doing with a successful spinoff of Viatris, with all this money coming in that will allow them to innovate across the board on all of the different types of solutions they're developing there. I would call it a value PE, not deep discount value. That would probably have to get down to maybe a 8 or 9 for that. But at an 11.78, that sure beats most of the stocks out in the market right now. And I really foresee years of growth ahead because the profits from the vaccine can be redeployed in research and development. The starting yield is 3.18%, which I highlight. It is solid. Payout ratio is low at only 37.5%. And the 5-year dividend growth rate is a 5.39% per year on average. There's room to grow it. Now, what I would say, as you can see in the stock chart, it's a wacky chart. This is a stock that really hockey sticked in the late 90s. Then it plummeted over the course of a few years there, about 5 years. And ever since, it's been recovering. I did some research and I found an article from The Motley Fool that really shed some light on why it went down starting in 2000. In 2000, they acquired Warner Lambert. This was a huge acquisition at the time. I think like $90 billion, which was like a landmark acquisition of that time. And they acquired it for Lipitor. Now, what this just goes to show is what can happen when a mega merger doesn't quite pan out. I thought that this thing hockey sticked and went kind of to a peak in 2000 and started trending down after because of the blue pill basically that they invented. However, I was actually inaccurate in that when I started looking at old annual reports on their website and I started looking through the data, I couldn't really find a good reason, like what happened to this thing? Why did it peak in 2000? Well, basically what happened is, according to Motley Fool, which I agree with, it was this Warner Lambert acquisition got them very distracted. They stopped innovating. They were just really focused on Lipitor, and then it just kept trending down. And so I wanted to share this because as a stock analyst, when I'm looking at companies, sometimes there are mega acquisitions like AbbVie did with Allergan. That was kind of a merger acquisition. That was a lot of risk. That one panned out really well, but it just goes to show what can happen if they don't pan out so well. Anyway, I want to share some more on Pfizer. As you see in front of you right now, this company is a poster child of the risk of mega acquisitions in big pharma. Personally, it's also a poster child of why I like to diversify in big pharma, because in big pharma, patents are always coming off of patent protection. There's risk. It's not always up and to the right, like with Johnson & Johnson. Certainly with Viatris, you see that it's down. And if you look at the longer-term chart before the reverse Morris Trust with Mylan was headed down for many years. And so it's not always up and to the right. And that's why I like to diversify. There is risk in this industry. Now, worth noting with Pfizer, I started buying this in 2012 for $21.06. And so just shows a little bit of history that I personally have with this company. Now, I want to share yet another pharma stock. Why not? It's in the news and it is a value. Even though it's trended up, I like to average up. Let's talk about AbbVie. Check it out on the screen right now. This is a stock that I really enjoy because it was a deep discount value. Now I would say it's more just a value. It's not deep discount anymore, but boy, their third quarter earnings were amazing. And so they basically increased their third quarter earnings year over year, an increase of 38%. And on an adjusted diluted basis, it's an increase of 17.7%, which is still fabulous. I would say that their Skyrizi brand, boy, I always see those commercials on TV. And when I see them, I always think of how proud I am to be an AbbVie shareholder. And if you were to ask my wife, I actually start doing a happy dance when I see the pharma commercials anytime on TV from a brand that I own like AbbVie. And so what I would say that's so exciting is if you go all the way to the bottom of all of this text, this sea of text, is it says they raise 2021 GAAP diluted EPS guidance from 604 to 614 up to a new range of 629 to 633. They increase their adjusted diluted range up to the new range of 1263 to 1267. This company is increasing its guidance. We're seeing a theme today. Boy, these companies are doing well. They're trading at value, some at deep discount value, some just at value, but they're increasing guidance. The numbers are really good. And most importantly, I have to show you in front of you right now, the last point at the bottom, they announced a 2022 dividend increase of 8.5%, beginning with the dividend payable in February of 2022. And by the way, for AbbVie, their compound annual growth rate on average per year for the last 5 years is actually 17.11%. This is a company that loves its shareholders and loves to reward shareholders with dividend increases. And with that, I have a few metrics. As you can see in front of you right now, it's trading at a price per share of $116.75. And based on the forward estimates from analysts, which are a little different than what you saw on the last screen, the analysts take other data into account. I pull this from the analysis tab on Yahoo Finance. That forward PE is a 9 this year, 8 next year. And so more of a value than Pfizer. There's more risk than with Pfizer because they have a lot going with Humira, and Humira is coming off patent protection, and it's a big chunk of the revenue. It's less of the revenue now because of the merger acquisition with Allergan, which they pulled off successfully, but still there's some risk there because they have a lot of dependence on one drug that's coming off patent protection. Now, the starting yield is phenomenal at 4.83%. Payout ratio is less than 50%. It's down at 44.5%. Very similar to J&J's payout ratio, and so there's room to increase that dividend. And I just shared the compound annual growth rate of the dividend is amazing. Now the stock chart up and to the right, but you can see there was some volatility back there around 2017. And honestly, when it dipped in 2019, I started buying at $69.02. And so I like to average up. I'm still comfortable buying here. This isn't a core stock for me, but I may pick up some more. I just love this company at these prices because it gives a rare combination of a huge starting yield with dividend growth. It's a rare combination, and when you have that combination, it can produce magic for long-term dividend investors who are holding for multiple decades like I am. And so it's really exciting to see the good progress that's coming forth with AbbVie, but I think it's still a buy. But again, I got to remind myself, my main focus for this next year in 2022 is core stocks, but I'll make some exceptions. Honestly, all of the ones I'm mentioning here are kind of in that sweet spot buy territory, for me at least. Hey, by the way, if you enjoy the video so far, please go ahead and smash the like button. It means the world to me. It helps my videos reach more people out there on YouTube. And also don't forget to subscribe. I have more videos on the way all the time. And I am staying up late tonight working on this video for all of you. And so those subscriptions mean the world to me with the notification bell. Also, put in the comments below what you think so far about these pharma stocks. Now, with all of that, I want to go from pharmaceutical industry over to the sin stock industry. I have one last value stock to share with all of you today, and it's a deep value. It's just like Viatris in many ways. Not quite as much of a value as Viatris, but almost as much. So as you can see in front of you right now, I want to talk about BTI. BTI is in the sin stock industry. It's the British American company. I have owned this one for a very long time. I actually started buying shares in 2009. And so the price per share is $34.95. And I couldn't really get good statistics on forward guidance from Yahoo Finance analyst expectations. And so what I did instead is I pulled some Morningstar data, and Morningstar happened to offer a 2021 consensus estimate for this company at $4.30. So it places the forward PE at an 8.13, which is deep value discount territory for this company. And quite frankly, AbbVie's in that range. Could I call them deep value as well? Maybe it still is. I call it value, but honestly, it's on the border between value and deep value. Worth noting, I include Altria on there as a comparable. Altria's forward PE is a 9.7. Now, the dividends on this company are now paid quarterly. They used to be paid semi-annually. And on a quarterly basis, it's 74.5 cents, $2.98 a year. And so the starting yield is 8.53%. Let me repeat, 8.53%. As compared to Altria, which is also a deep value, that one's only in quotations, 8.04. Payout ratio is less than 70%, which is awesome. There's room to increase the dividend. Although, unfortunately, they have not been increasing the dividend. Over the last 5 years, it's actually come down a little bit. But worth noting, they moved from an old model where they were paying semi-annually, kind of the UK dividend model where they were paying a half-year, mid-year dividend that was really small, and then a big one at the end of the year based on performance. They've now moved more to a US-based dividend system, which is quarterly, and they increase it each year. And so eventually we'll get some compound annual growth rate on that dividend. Now, worth noting in the stock chart, as you can see, I honestly started buying this thing at $23 in 2009, but I've lost some money on tranches too. I bought this as high as $59. And that was in 2014. And again, it's trading at 35 right now, 34.95. And so it's a value. But that being said, boy, this thing, it peaked. It peaked back there in the day. And I bought shares a lot higher than right now. And so that's just a lesson to everyone out why it's important to have a long-term perspective, to diversify, to not have all of your eggs in one basket. From a capital appreciation standpoint, there can be volatility with dividend stocks, and I've certainly seen it with this particular stock. Now, I forgot there's some news with this stock. So as you can see in front of you right now, I want to share some news. And with BTI, it's very fascinating. But basically, the U.S. International Trade Commission made a determination, and they basically determined that Philip Morris and Altria's heated products, the IQOS, was infringing on some patents owned by BAT Group, or the group behind BTI, same thing. And so basically as a result, the ITC is issuing an order that's preventing Philip Morris and Altria from importing IQOS products. They're not going to be able to sell them. And so BTI is going to be selling their heated products here in the U.S. Now, to my understanding, none of this affects international sales of IQOS through Philip Morris, which are through the roof and doing really well. And I know that already Altria is appealing this decision. And so certainly things can change. They're very dynamic in this marketplace, but that's a piece of good news and why I like to stay diversified. I own all the SIN stocks. I own Philip Morris, Altria, BTI, and even Universal Company. And so I own all of the SIN stocks. I own all, or not all, but a lot of the pharma stocks. I diversify on purpose because things like this can happen. All right, everyone, I hope you enjoyed the video today. Please go ahead and smash the like button again if you enjoyed the video. Don't forget, I have a really awesome Patreon, which I will link to in the pinned comment below. It is late at night. I thank you so much for hanging in there and supporting the video today with a comment or like or subscription or all of the above. And before I leave today, in terms of a full disclosure, I own the stocks mentioned today. I am long BTI, ticker BTI, Altria, ticker MO, Philip Morris, ticker PM, Universal, ticker UVV. I am long also on Johnson & Johnson, ticker J&J, AbbVie, ticker ABBV, Pfizer, ticker PFE, and Viatris, ticker VTRS. Worth noting, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose a lot of money in the stock market, as we've seen with some of the charts in the video today, how there's a lot of volatility. And so it's always important to proceed with caution and consult the experts. All right, everyone, I will see you in the comments below, and I wish you a wonderful day.